We are covering the Investment Advisors Act of 1940 for the Series 65 exam. This federal law defines what an investment advisor is, and it's a critical concept you must master. To be considered an investment advisor under the Act, a person or firm must satisfy a simple three-prong test. They must be providing advice about securities, be in the business of providing that advice, and receive compensation for it. Think of it as the ABC test: advice, business, and compensation. Let's break this down with an exam-style example. Imagine a blogger who writes about stock market trends and offers a premium subscription service with specific stock picks. Are they an investment advisor? Let's apply the test. First, are they giving advice about securities? Yes, the stock picks qualify. Second, are they in the business of doing so? Yes, it's a regular activity, and they present themselves as offering this service. Finally, do they receive compensation? Yes, the premium subscription fee counts. Since they meet all three prongs, they are an investment advisor and must register. The exam will try to trick you with exclusions. A common trap involves professionals like lawyers, accountants, teachers, and engineers. Remember the mnemonic L.A.T.E for these professions. These individuals are excluded from the definition of an investment advisor only if the advice they provide is solely incidental to their professional practice, and they do not charge a separate fee for it. For instance, if an accountant, while preparing taxes, suggests a client invest in municipal bonds for tax purposes, that's likely incidental. But if that same accountant starts offering a separate financial planning service for a fee, they have crossed the line and must register. Another key area tested is the distinction between federal and state registration. The primary factor here is assets under management, or AUM. Generally, advisors with less than $100 million in AUM register with the state. Once an advisor has $110 million or more in AUM, they must register with the SEC at the federal level. Advisors with AUM between $100 million and $110 million have the option to register with either the state or the SEC. A common exam trick is to present a scenario with an advisor who has, for example, $95 million in AUM but also advises a registered investment company. In that specific case, they must register with the SEC, regardless of their AUM. Remember this key phrase to keep it straight. Big means federal, small means state. Investment advisors register with either the state or the SEC, never both. When you see a question about registration, first check the AUM, then look for any special conditions like advising a mutual fund. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.